For the position of yes. So those who are online, good evening. So we finish off the last question that you are dealing with. We can finish off that last question that you are dealing with. You said it was for which sitting? So we check the question for May 2021. We can now conclude that question for May 2021. May 2021. May 2021. So there's a question for May 2021. It was question number 5, part C. Yeah, so we did Roman letter 1, isn't it? Yeah, we finished that. Even the Roman letter 2, we calculated the standard deviation, isn't it? Yeah, so did we compute the coefficient of variation? No. Yeah, so let us first write something brief about the coefficient of variation. So those who are joining in, we are simply finishing the question we are dealing with last time. The question for May 2021, question number 5, part C. So we are on the Roman letter 2, coefficient of variation. We are on the Roman letter 2. We had already calculated the standard deviation. So for the coefficient of variation, we shall summarize that. We shall summarize that it is the relative measure. It is the relative measure of the risk. It is the relative measure of the risk. It is the relative measure of the risk. And it indicates the risk per unit of return. And it indicates the risk per unit of return. It indicates the risk per unit of return. Then we continue by noting that the lower the coefficient of variation, the lower the coefficient of variation, the less risky the project is. The lower the coefficient of variation, the less risky the project is. The lower the coefficient of variation, the less risky the project is. So let us see how to compute the coefficient of variation. So to get the coefficient of variation, you simply get the standard deviation of the NPV. Then you are to divide by the expected NPV. Expected NPV. So when you want to calculate coefficient of variation, we simply get the standard deviation of the NPV. We divide by expected NPV. So Roman letter 2, last time you computed the standard deviation for the NPV. The last item you calculated. That standard deviation was which? 0.346 or 8. Like that. 8. I would like at least another one figure, one more here. 8 letters. Another 8 letters. 1, 2, 6, 9. Because there are in millions, I just want maybe we can have it 9 like that. Because they are in millions. Then expected return we calculated in the Roman letter 1. It was 0.1. 0.5. Also, I'm give them in like 4, 6 or 6 figures. 0 is 1. Then 6, 5. 1. So we can just have it as 1 like that. So that they correlate. So that now will give you the coefficient of variation. It should be able to give you the coefficient of variation. So now the last part of the question, Roman letter 3. We can now check the Roman letter 3. So Roman letter 3, they were saying that assuming, assuming the firm's average project had a coefficient of variation of between 1.0 and 2.0. Explain whether the project will be, of high, low, or average. So they were asking you that whether the project will be high, low, or average risk. So just in case the coefficient of variation is between 1.0 and 2.0. So when we were able to write some short notes today about coefficient of variation, you can see also the lower the coefficient of variation, the less risky the project is. So, because it is between 1.2 and 2.0, so 1.0 and 2.0. So the lowest is 1.0. So when it is 1.0, it is the lowest risk. When it is 2.0, it is the highest risk. So if it is in between, it is the average, because there are 3. So they have given you 1.0 and 2.0, but they are saying if the project has a coefficient of variation which is between what? 1.0 and 2.0, then when you are ranking them, the one with the lowest coefficient of variation is normally ranked as number 1. The one with the lowest coefficient of variation is normally ranked as number 1. So when it is 1.0, it has the lowest risk. When it is 2, it has the highest risk. So in case it is in between, it will be average risk. You get that part? Yeah, so now we can conclude on that from letter 2. We can note that if the project had a coefficient of variation, which is between 1.0, which is between 1.0 and 2.0, which is 1.0 and 2.0, then it means that it has an average risk. It means that it has an average risk. It has an average risk. Then you continue on the side by writing that if it is 1.0, if it is 1.0, then it means it has a lower risk. If it is 1.0, it means it has a lower risk. However, if it is 2.0, If it is 2.0, then it means it has a higher risk. If it is 2.0, then it means it has a higher risk. So that's now a question on the decision tree diagram. So I will leave you with a question you will attempt as an assignment, because we have done 3 questions. So you can try this one. You'll go through it as your assignment. You'll try this one as your assignment and see how it will work for you. So you will try the one for May 2018, question number 1, part C. May 2018 as question number 1, part C. May 2018 as question number 1, part C. But that one you will try it as an assignment. So we have done 2 questions on the decision tree diagram. So I want us to go to the second method. When you check through your handout, I've given you, now we have done some, not number 2, it was the decision tree diagram. So now I want us to go to simulation analysis. Simulation is number 3. After the decision tree diagram, I want us now to discuss the one for the simulation analysis. We now go through the simulation analysis. Can now check the one for the simulation analysis. When it comes to simulation, analysis, when you check through the notes, they were saying that this method is used to incorporate risk in the capital budgeting through the use of the random numbers, which are normally generated out of the probability assigned to each cash flow. So after creating the random number range, NPV is computed in order to evaluate the project. So we shall be using the random numbers to identify the cash flows. We shall also be using the random numbers to identify the economic life. Then we also calculate the expected NPV to see how it will work. So I've also given you advantages and disadvantages. So those ones you go through them. So now I want us to get a question on the simulation in your past papers. We can now get a question on simulation in your past papers to see how it will work. So the first question I want us to deal with, we can check the one for November 2016, question number 1, part B. November 2016, question number 1, part B. November 2016. We can go through the question number 1, part B. November 2016. Question number 1, part B, November 2016. There is a question number 1, part B. So that question 1, part B for November 2016, the question reads that SKB Limited is considering a proposal to manufacture a new drug named Millennium. A new drug named Millennium. What was the purpose of November 2016? Question 1, part B. It is on which page? Sorry? 50. Page 50. Others 55. So it should either be on page 50 or page 55. So they have stated that SKB Limited is considering a proposal to manufacture a new drug named Millennium. So the drug will be manufactured using a machine which will cost shillings 13 million, which will be able to cost shillings 13 million. So the cash flows and the drug life relating to the Millennium have been estimated as variables with the following distribution. So they gave you annual after-tax cash flows. They gave you the probability, the drug life in years, and also the probability. The minimum required rate of return from this investment is 16. The company has approached you as a financial management expert to perform an analysis of the above project. So required, they were able to say that you, Roman letter 1, using the following random numbers, perform 10 simulation runs of the net present value of this project. Then Roman letter 2, determine the expected net present value for the project. So what we do, we normally start by identifying the random number range. So we do the random number range to identify the cash flows and also for the drug life, because that's where they gave you the probability. Once you have done that, now it will be possible for you to get the NPV. So let us create first the random number range for each item. There are only 2 of them. You can see the random numbers, they were given as 4. There were 4 letters, you see that? The first 2 will be used to identify the cash flows. The second 2 will be used to identify the drug life. So that's now what we should be able to come up with. But first, we create the random number range. The first thing we should do is to come up with the random number range. So I will do the first one for the annual cash flows. The first one I will do for the annual cash flows. So the first one should be for the annual cash flows. So for that item, we shall be having the cash flows, then the probability, then also cumulative probability, also the cumulative probability, then also the random number range. This one is random number range, the random number range. So we shall be having cash flows, probability, cumulative probability, and also the random number range. Also the random number range. So we start with the first one. We start off with the first one. You can see the first annual after-tax cash flow. How much? Yeah. So probability of it occurring, they gave us 0.02. So cumulative for the first one, it will just remain 0.02. So now the range, it will start from 0, 0, because we need 2 letters. I said the first 2 letters are for the cash flows. The second 2 are for drug life. So we want the range from 0, 0 to 0. But anyway, we are only doing the one for simulation. So it will be ranging because this one is the upper part. So you want the lower quadrant. The lower quadrant will start from 0, 0 to 0, 1. So that the next one now will start from 0, 2 upwards. As now we have it that one. So the next item is 1500. The next one is 1500. So probability of it occurring is 0.03. So cumulative will be 0.1. Yeah, so now we start from 0.2 to 0.4, like that. From 0.2 to 0.4. The next item is 2 million or 2,000. There are 3 zeros at the top. So that 0.15, then this one is going to be 0.20. So that we start from 0.5 to 19. 0.5 to 19. We start from 0.5 to 19. The next one they have given us 2,500. So the one for the 2,500, the probability is also 0.15. So cumulative will be which figure? 0.35. So the range now we start from 20 to 30, 34. Then the next one is meant to be 3,000. So the one for the 3,000, it is 0.30. So cumulative will be which figure? 0.65. So that means the range will be from 30 what? 35 to 64. So the next one is 3,500. So also this one, the probability is 0.2. 0.2. So cumulative will be which figure? So the range will start from 65 to 84. Then the last one is the one for the 4,000. So it is 0.15. So it will be 1.0. So you start from 85 to 99. So that is now the random number range for the annual cash flows. So we do the same for the drug life. Anywhere they have given you a probability, you create the random number range. So let us now go to the one for the drug life. Let us now go to the one for the drug life and also establish the same. Now also check the one for the drug life. So now we do the same. The one for the drug life. So when it comes to the drug life, it is in terms of the years. So there will be the years, then probability, and also cumulative probability, and random number range. The random number range. So you see the first one, they gave us how many years? So for the 3 years, the probability is 0.05. So cumulative will still remain 0.05. So the range will be from where? 00 to where? 00 to 04. So the second one is 4 years. When it is 4 years, it is 0.10. So cumulative will be what? 0.15. So that we start from 0.5 to where? 14. The next one will be 5. So it will be 0.3. So that cumulative is 0.1. So that we start from 15 to where? 14. 94. The next one, they gave us 6 years. So the one for the 6 years, they gave us 0.25. So cumulative will be which year? So that the range will start from 45 to 69. The next one, they give you 7 years. So this is 0.15. Cumulative will be 0.85. So that it starts from where? 70 to 84. Then there is the one for 8 years. So this one is 0.1. So that we get 0.95. Start from 85 to 94. Then there is also 9 years. So from where? 0.03. So that will be the same as 0.98. So that we start from 95 to. So the last one, they gave you 10 years. So this one is 0.02, which will give us 1.0. So that now it is 99. So once we have created that random number range, we now want to answer the question. We shall now be able to answer the question. So we want to calculate the expected NPV. We want to compute the expected NPV. So to calculate the expected NPV, so random numbers, we refer to them as runs. Random numbers, we refer to them as runs. Then we shall be coming up with the cash flows. Then once we get the cash flows, we discount them at the present value, interest factor for the annuity. The question had given us the cost of capital. Are you able to see our cost of capital? It is 16% for each year. So that you will be coming up with the present value for the cash inflows, then also present value for the cash outflows, so that we get the LVB like that. So that we get the NPV in that order. So you can see the first run. So the first run, it was which random number under the Roman letter 1? 5397. So this one is 5397. So I want you to put the random number range for the cash flows. You can see our random number range for the cash flows. So that 53 is between which figure and which figure? The range for the cash flows. The 53. It is between which amount? The range. It is 35 to 64. So between 35 to 64, when you check the cash flows, it is how much? It is 3,000. So the cash flows there will be 3,000. Then 97 will be the drug life. So you can see the random number range for the drug life. So 97 is between which range and which range? 95 and yeah. So when you check how many years are there, yeah. So there are 9 years. So I want you to go to the annuity table. You see your annuity table, the second table. So check 16% in period 9. In that second table, I want you to check 16% in period 9. 16% in 9. The one for the unreachable. Now pair which figure? 4.606. Yeah, so you multiply this cash flows by this figure. Multiply this one by this figure to give us present value for the cash inflows. So we take the 3,000 multiplied by 4.6065. Sorry? 13. Sorry? Man and drag life. Random number in your life. Yes. Yeah, so 97. So is it okay at that point? And then present value for the cash outflow is the initial cost. So that project was costing how much? 13 million. Yeah, tumepatiwa password. So it is 13 million. Yeah, so the drug will be manufactured using a machine which will cost how much? 13 million. So present value for the cash outflow is 13 million. So there are 3 zeros at the top. So now you simply subtract 13 million from 13, 8, 19.5 million so that we get our NPV. So that means our NPV should be which figure? It will be 819.5. So that's now the first round. That's now for the first random number. So we go to the second random number. You can see the second random number. It is 66. So 6699. It is 6699. So we start with the 66 to give us the cash flows. We start with the 66 to give us the cash flows. So 66, you can see it's between 65 and 84. So 65 and 84. How much cash flow is there? Yeah, so our cash flows will be 3,500. Then this 99 is to identify the life. So go to the random number range for the graph. 99 is between 98 and 99. How many years are they? 10. Yeah, so you go to the table. You go to the table, 16% in period 10. 16% in period 10. Now we are using the second table. 4.8, 332 like that. Yeah, so that we multiply this figure by the 3,500 so that we get the present value for the cash inflows. Not happy? 16. 916.2. It will remain the same. The 13 million is the same all through. So when we subtract, it will give us which figure? That's 916.2. So that's now the random number 2. We go to the random number 3. So the random number 3 is 3081. It's 3081. Is meant to be 3081. So we use 30 to identify the cash flow. So 30 will give us how much cash flows? 2,500. Then I want you now to check 81 to give us the economic life. 7 years. Then now you go to the table. What is 16% in year 7? 4.0. 336. 386. So also multiply 2500 by 4.0386. Sorry?
10,096.
10,096. It is 10,096, isn't it?
Yes.
0.5. So here 13 remains. So it will be negative what? Negative 9. 2. So online, is it clear? Those who are online, I hope you are following. Online, is it clear to everyone? So we go to the next item. The next random number is 1909. So 19 should give us the cash flows. 19 should give us the cash flows. How much cash flows will be there? It is 2,000. Then 09 should give you the cash flows. There are how many years? There are 4 years. So 4 years. Also, you go to the table 16%. 16% in year 4. Sorry? 2 points. 9, 8, 8. Then you also multiply by 2,000, which will give us which value? 55, 96.5. 96.4. So the 13 will not change. So I want you now to arrange that way up to the last random number. There are 10 of them. There are 10 of them. Then once you finish, you will get this total. They want you to get that total. So continue and up to the last random number, because there are 10 of them. So there is 31, 67, 81, 70, 38, 75, 48, 83, 90, 33, and also 58. So you finish it so that we check something more on the same. So for those who are going for the prayers, we can use that time for the prayers.
Yes, I'm good. What about you? Happy that you are. I wasn't. Kuconfirm kama ni ukweli hiyo. Kwanza juzi ile message sinileta no, swali ni utajuaje nitakuza nafaa kutumia watu wengi kuna mahali nimekwamia sasa. Sitaenda sasa. Lakini kinaeleweka. Wanajua nitakuwa nikisema kwa retreat. Shida ni moja, hata tukielewa, hata ikiisha nakuta jioni hakuna kitu ya maana, ndio sababu wanaenda. Sika venye tulikuwa tunaelekea ikafikisha. So 6 years plus 6 is
Yes. I was there.
Thank you. So,
So what are we getting as the total? Negative 11. 841. 841. Like that. So for us to compute the Roman letter 2, determine the expected net present value of the project. So to compute expected, yes.
that's a question.
Mm.
Why answer?
Mm.
And then further system of 46. 11,845.65.
Kama hizi ziko sawa, no problem. Na issue tu hapa there is no problem. But this one, because of the rounding off. So one is closer to this one is the key because of the issue. So to get the expected NPV, it is just the average. You divide by the number of the random numbers. So just take the 11,841.65, which is negative. There are how many random numbers? 10. So divide by 10 now to get the expected NPV. We divide by 10 so that we now come up with the expected NPV. So now our next question was December 2021 exam for December 2021. December 2021, question number 5. So check December 2021. Question number 5. December 2021. Not the pilot paper, but the one for the real exam. December 2021. Question number 5, part A. We check December 2021. Question number 5, part A. So that question 5, part A, the one for the real exam. There was the pilot paper and the one for the real exam. So we check the one for the real exam. December 2021, question 5, part A. So the question reads that an investor is considering introducing the new classic pens into the market. The firm is contemplating investing in purchase of a new plant costing 250 million. The plant has a useful life of 5 years and it is to be depreciated to 0 on the straight line basis. It is to be depreciated to 0 on the straight line basis. So due to the market, selling price per unit, unit variable cost, and annual sales volume for the new plastic pens have been estimated as follows. So unit selling price, there is the value and the probability. Unit variable cost, the value and the probability. Annual sales volume, that is units, also volume and probability. The firm will incur annual fixed operating costs. The firm will incur annual fixed operating costs, excluding depreciation of $20 million. Excluding depreciation of $20 million. The company's cost of capital is 10%. The corporate tax rate applicable is 13%. Now required, Roman letter 1, expected net present value of the project. But Roman letter 2, they were asking you to simulate the NPV using the following random numbers. So you can see this time, each random number has how many letters? Each random number, it has how many letters? There are 6. The first 2 will be to identify the unit selling price. The second 2 will be to identify the unit variable cost. Then the last 2 will be to identify the sales volume. So that's now what we shall be having. But Roman letter 1 has no issue of simulation. Roman letter 1, we just get a normal NPV. So for the Roman letter 1, let us see how to get the normal NPV. Remember, Roman letter 1 has no element of. Roman letter 1 has no element of a simulation. So we simply calculate the normal NPV. We shall simply be required to calculate the normal NPV. So NPV is supposed to be given by present value for the cash inflows. We minus present value for the cash outflows. Then we need to calculate the annual cash inflows. So to calculate the annual cash inflows, it will be, so the question gave us the selling price, it is P, minus the variable cost per unit, it is V. So multiplied by X. X are the number of the units. So this one is the selling price per unit. This is the variable cost per unit. So we need to get the contribution. Then multiply the number of the units. But you also subtract the fixed cost, because the question had also given us the fixed cost, so that it will be giving you earnings before depreciation and the tax. So normally, once you get this figure, once we get that figure multiplied by 1 minus the tax rate, but we add the depreciation multiplied by the tax rate, because depreciation is not an outflow. It is not an actual cash outflow. It is simply a provision to reduce the taxable income. So if you prepare the cash flow statement, if it is a cash flow statement, we normally start with the sales revenue minus the variable cost. We get the contribution, we minus the fixed cost, we get earnings before depreciation and tax. Then we minus depreciation, then we tax, then we normally add backward. So instead of you preparing the cash flow statement, just calculate it using that format. Just get it in that manner, but now after that, multiplied by the depreciation, multiplied by the tax, and then you add it back. So one of the items is to calculate expected selling price. Expected selling price. We need to come up with the expected selling price. So to get the expected selling price, we are not subjecting it to simulation. We just take each price, multiply the probability, then you add them together. The first one is 25 shillings. Probability of it occurring is 0.3. Then we add, we also have 35. Probability of it occurring is 0.5. The last one is meant to be 45. Probability of it occurring is 0.2. So when you add them together, you will be coming up with the expected selling price per unit. We get the expected selling price per unit. 30, 34. Then we also need to compute expected variable cost per unit. We also calculate the expected variable cost per unit. So even this one was the expected selling price per unit. So even this one, you simply take what you are given there as 10, probability of it occurring. Probability of it occurring, it is 0.2. We also add, there is 15. Probability of it occurring is 0.4. The other one is meant to be 13. Probability of it occurring, it is 0.4. So we also add them together. Exactly 20. So we also calculate the expected sales volume. in units. Expected sales volume in units. Sales volume in units. Whereby you also take 4.5 millions, also multiplied by 0.3. You also add 6 millions multiplied by 0.4. Also 7.5 millions multiplied by 0.3. Multiply 6 millions. So apart from that, you will also calculate the depreciation per annum. We shall also compute the depreciation per annum. So to get your depreciation per annum, you can see in the first paragraph, that machine was costing how much? So it was on the straight line basis. It is 250 millions. The salvage value is 0. But economic life was how many years? So divide by 5 years so that we come up with it is 50 millions. Yeah, so once we have done that working, we come back here to give us our annual cash inflows. We now go up there to give us our annual cash inflows. So we start with the P. So we are using this formula. So our P, the selling price per unit we have gotten but what? 34. Subtract the V. V is the variable cost per unit, which is 20. Then X is the volume, which is 6 millions. Like that. Then the question had given you somewhere the fixed operating costs. You can see before required, the firm will incur annual fixed operating costs, excluding depreciation of how much? 20 millions, like that. So that figure that you get multiplied by 1 minus the corporate tax. You can see the corporate tax that before required is what percent? 30% is 0.3. Then now we add. So this one is depreciation multiplied by the tax rate. So depreciation is 50 millions multiplied by 0.3. So that will give us our annual cash inflows. It will be able to give us now the annual cash inflows. So it will be able to give you the annual cash inflows. So inatupea ngapi? 59.8. So once you get the 59.8, so now we can get our NPV. So we get the present value for the cash inflows. So those cash flows are the same every year for the 5 years. So it is an annuity. So you take the annuity multiplied by present value interest factor for the annuity. Cost of capital is given. Cost of capital, they gave you what percent before the corporate tax. The company's cost of capital is 10%. So it will be 10% for 5 years. So we take the 59.8 million. That's now our annuity. That is now meant to be our annuity. So check in the second table. What is 10% in year 5?
$3.7908.
3.7908.
790.
3.79.
Yes.
08. So it is giving you which figure? 226 point. Sorry?
689.
689. Like that. So that will give you 6898. 84. But anyway, that can work. Because they gave us in millions, it will not give us a big difference. So you less present value for the cash outflows. So present value for the cash outflows is the initial cost. Remember 250 million. So that you get the NPV like that. So that NPV, is it negative or positive? It will be negative, isn't it? Yeah, so if it is negative, you advise them to reject the project. If it is negative, you advise them to reject the project. So someone is asking, why are we multiplying depreciation by the tax rate? I explained in details. Nili explained sana your statement. I gave you an example of a cash flow statement where I said you start with what? Sales revenue, subtract variable cost, ukapata contributions there. Subtract the fixed cost. Ukapata earnings before depreciation and the tax. Then una minus depreciation to get earnings before the tax. Then you subtract what? The tax to get the earnings after the tax. But you add back depreciation. Your part annual cash. So at our level, at when your direction, you to section 3. The cash flow statement, you did it in section 3. At your level, at your level. So depreciation, I said it is not at our actual cash flow. It is simply what? A provision to reduce the taxable income. So instead of you following that long procedure, if I could have prepared the cash flow statement, you could even spend 30 minutes only on the same item. So the reason why you are adding back depreciation more by the tax rate is that part of adding back the depreciation in order to get the annual cash flow. So this statement, you can prepare the cash flow statement. You start off by this multiplied by this will be the sales revenue. Then subtract this multiplied by that is the variable cost. Then minus the fixed cost, isn't it? We get earnings before depreciation and the tax. Then subtract depreciation. Then get the earnings before the tax. Then tax. Get the earnings after the tax. But because depreciation is not an actual outflow of cash, it is simply a provision. So add it back. Then you get the annual cash flows. So it is the same thing, like excluding depreciation here. but add back depreciation multiplied by the tax rate. It will give you the same figure. If I do it, it's an alternative way of doing the same. But now why should we go all that wrong direction? Simply get the earnings before depreciation and the tax. Then do what? Tax. But add back depreciation multiplied by the tax rate, which will give you the tax benefit on that. Even when you are doing something to do with the capital structure theories, you remember the last item, the present value of the interest tax benefit, but it was simply the debt multiplied by the tax rate, which will still work the same. So, as we shall not go to the procedure of preparing the cash flow statement, what I would advise you, because in the exam, hakuna wakati, just remember to follow that formula. It will give you the same. But those who are in section 3, you are to prepare that cash flow statement because it is required. They will give you marks. But at your level, you only want this LPV. So get to know how to get a shortcut to get the value for that. So I hope it is making sense. Those who are online, someone was asking, why should you add back depreciation multiplied by the tax rate? So is it making sense at that level? So that should be the Roman letter 1. That should be the Roman letter 1. So let us now go back to the Roman letter 2. Roman letter 2 is simulate the net present value using the following what? Random numbers. So what we do now, we create the random number range for each. Kama mlikuwa exempted, so you get a bit of it at this level. Get a bit of it at this position. So we start with the random number range for the unit selling price. We start with the random number range for the unit selling price. The unit selling price. So they have given you the value. They have given you the value, then probability, then cumulative probability, then random number range, the random number range. So value for the first one, you can see 25. Probability is what? 0.30. So cumulative will still remain 0.30. So the range will start from 00 to where? 00 to 29. From 00 to 29. The next one is 45. So 45, they gave us a probability of 0.0. So cumulative will be which here? 0.8. So that we start from where to where? 30 to 79. The next one is 45. So the one for 45, it is 0.1. So cumulative now will be what? So that you start from 80 to where? 99. So that is now for the unit selling price. We also do the same for the unit variable cost. We shall also be required to do the same for the unit variable cost. So for the unit variable cost, there is also the value. There is also the value. Then probability, also cumulative probability. Then the random number range, like that. So the first one is 10. Probability of it occurring is 0.20. Cumulative is still 0.20. So that we start from 00 to where? 00 to 19. The next one is meant to be 15. So 0.4. So cumulative will be 0.6. So that we start from 20 to where? 59. The next one is 30. Probability is 0.40, which will give us 1.00. Then the range will start from 60 to where? 99. So that is now for the unit variable cost. We do the same for the annual sales volume. We do the same for the annual sales volume. We do the same for the annual sales volume. Annual sales volume. Annual sales volume. So when it comes to the annual sales volume, it will also be the volume, then probability, cumulative probability, then random number range. Like that. The random number range. So the first one is 4.5. 4.5 millions. Probability is 0.30. So cumulative is still 0.30. Then the range will be 0 to 29. There is also 6 millions. So probability will be 0.4. Cumulative is 0.7. So that we start from 30 to where? 69. Then the last one, they gave us 7.5. So probability is 0.3. So that you get 1.00. So it is 70 to where? So once we have done that, we now also get the annual cash flows. Going back again to the same formula. Using now the same formula to get the annual cash flows. So we shall come up with a schedule for that. We shall come up with a schedule for that, whereby you will be having the runs. Runs are the random numbers. We shall be having the runs. Then you remember P minus B, then X minus F, then after that 1 minus the tax rate, and we add depreciation multiplied by the tax rate, so that now you get your annual cash inflows for each random number. The annual cash inflows for each random number. So we just present it in that order. We shall just be required to present it in that order. So the first round, you can see the first random number. It is 75. So it is 75, 25, 60. Yeah. So we start with 75. So check 75. It will give us which unit selling price? 35. It is 35. Yeah. So our P is 35. Then go to 25 to give you the variable cost per unit. 25, not pair 15. So that will be 15. Then I also want you to go to 60. 60 to give us X. And acquire 6 millions.
Yeah.
So that one will be 6 millions. Then we need to less the fixed cost. So fixed cost, those one they don't change. They gave us 20 what? So it is 20 millions like that. Then after that, the figure you get, we multiply by 1 minus 0.3. So depreciation we had already calculated. Even this one will not change. How much was our value for the depreciation per annum? It was 50 millions. So also multiply by 0.3. So that should give you annual cash inflows for the first random number. So it will be able to give us the annual cash inflows for the first random number. It's 5 millions. So I'm told this one should be 85. It is exactly 85. So that is now for the first random number. We go to the second random number. Our second random number was which year? It was 65, 80, 55. So we start again. 65 will be there to identify the price. How much is that price? 35.
Yeah.
So the price I'm told is still 35. Then I want you to go to 80 to give you the variable cost per unit. It is 30. Then I also want you to go to 55 to give us the sales volume. It is 6 million. So 20 million still remain. Then 1 minus 0.3. Then we get another constant, the 50 million multiplied by 0.3. That one will remain constant. $22 million. So this one I'm told is 22 million. Online, I hope we are together. Online, are you getting the same figures? Yes, they are saying they are getting the same values. So we go to the random number 3. Random number 3, you are given which random number? 95, 75. So 95, 75, that. So 95, it had to pay a mini. It had to pay a 45. Yeah, 95, it had to pay a 45. Then 75 will give us which here? That to pay a 30. Then 30 will give us 6. That to pay a 6 minutes. Then also 20 millions. Then 1 minus 0.3. Being given in about just 30 million multiplied by 0.3. That was 64 minutes. So this one is 64 minutes. So the next random number is 86, 99, 86, 99, 50. So what do we have 86? It had to pay a which price? It had to pay a 45. Then 99 in a many. it is 30. Then 50 inatupea ngapi? Bado ni 6 million. Sasa hii haitabadilika. Sitakuwa ngapi? Yeah. Hiyo sasa it is just 64 million, isn't it? Then we go to the last random number was 54. So it is 54, 40, 25. So 54 should give us which here? 35. Then 40 should give you 15. Then 25 should give us what? 4.5. So 20 is still remaining. Then 1 minus 0.3. Sasa hiyo inatupea ngapi? $60. We're going to press 64 minutes. Yeah, so that part was to enable you to identify the annual cash flows. So now we want to perform the runs to give us the expected NPV. So what do we do? So now what we should be required to do? So we shall also arrange it in the same manner, the runs. Then you will also have the column for the annual cash flows. Annual cash flows. Then present value interest factor for the annuity. So there was no simulation for the life. So it will apply to all of them. So the cost of capital they gave us what percent? Was it 10%? But the project was having how many years? Was it 5? Equal 5 years, isn't it? Yeah, so to kichukua your cash flows not by that figure, we shall be getting the present value for the cash inflows. Then you will be required to subtract present value for the cash outflows so that you get the NPV. So we can summarize it in that order. We can summarize it in that order. You have the runs, then annual cash flows, present value interest factor for the annuity, 10% for 5 years, present value for the cash inflows, present value for the cash outflows, then NPV. So cash flows, you see those annual cash flows. The first run, it is 85. The second run is 22. The third was 64 million, also 64 millions, also 64 millions. So those are the cash flows that we have just calculated as our annual cash inflows. Then, you remember in the table, 10% in year 5 for the annuity table. 3.7 908. Yeah. So I want you to take 85 millions multiplied by 3.7908. So, sorry? Sorry? 322.218 like that. It is exact. Yeah, na hii ingine haibadiliki. Remember the initial cost of the project. It was 400 around. Unakumbuka 250 millions? Yeah, so that must subtract 250 millions. So that we get our NPV. NPV inakuwa ngapi? 70. 208. So this one would not be changing. There was no simulation on this item. So if you apply to all of them. So you also take 22 million multiplied by 3.7908. So this one should give us which value? 83.3976. It is the same. It will not change. It will just remain the same. So that will give us which figure? 30 negative 166. 166.6034. 24. Like that. Then this one is also remaining the same. Because if I multiply, sorry, 242.6. 112 million. Then ingine ni 250 million. So itakuwa negative what? Sorry? Like that. So it is negative. Yeah. So from there, so kila kitu tabaki the same. Now hakuna mabadiliko because this will still be 244. 244.6112. Hii ilikuwa 41 of 244. So this one was 42. Yes. But there's no change from there. Yes. Okay. So 250. So this one is still negative what? 7.388. And this one is still 3.7908. So you are still having 242.6112. So hii bado ni 200 and here negative 7.388. So add them together to give us the total NPV. Negative 116.5508. Yeah. But they wanted you to get the expected NPV. So that expected NPV, we just take that negative 116.5508. But there were how many rounds? There are 5. Yeah, so divide by 5. so that you come up with our expected NPV. We simply take the NPV that you calculated, divide by 5. Negative 23.3. 3.1 like that. 3.1 like that. Yeah, so that's now our Roman letter 2. So they also asked you the Roman letter 3. Roman letter 3, they were asking us determine the probability that the product will be what? A success. So mnaangalia the runs which are positive, divide by the total. The runs which are negative. Is it negative? Yes. But the positive is only 1. So the probability will be 1 over the total. 1 over 5. See, the successful one is only 1 run. But total are how many runs? 5. So probability of the success, it will be 1 over 5. Probability for the success will be 1 over 5. The 1 is this which was positive. 1 run was positive, 4 runs were negative. So probability for failure, it will 4 over 5. Probability for failure, it will be 4 over 5. So probability for the success, it is 1 over 5. 1 over 5 is 0.2. Yeah, so that means failure will be 0.8 because the 2 must add up to 1. So probability of success is 0.2, but probability of failure will be 0.8. So that was the question. That question had been given almost the same in the pilot paper. You see, December 2021 pilot paper. December 2021, the pilot paper. Question 3. You see the same December 2021, the pilot paper. Now your question 3. An investor is considering introducing a new product called named what? Superbug and in the market. So this will involve purchasing the plant costing how much? 300 million. Yet it requires 250. So these others, I suspect they are they are changed in the sales volume. So you can see the selling price, value, and probability, and also variable cost, value, and probability, sales volume, value, and also probability. Then the cost of capital is what figure? 12%. Corporate tax rate is 30. So this question, I suspect, haina fixed costs here. Yeah, so here place your fixed cost, it is just not there. So we don't factor it in. Then, when you are calculating the cash flows, you remember that? Yeah, P minus B, then X minus F. So that F is not there. So we ignore the part of F, isn't it? Then 1 minus the tax. And then also remember how to get the depreciation. So economic life was how many years? In the note number 1, there are 5 years. So you will follow that same. The question is just the same. Then now you can see part B. Part B, kuna vile wametupea random numbers. So this one will be 70. The first one is 76, 20, 55. Yes. So you use 76 to identify the selling price, 20 to identify the variable cost, but sales volume we use 55. The same way, there are 6 of them. So 75, sorry, 76, 20, and 55 will be the first round. And then you do the same. So determine the expected NPV. So the question was just the same. Probability that this product will be what? Success. So this time round, they have also asked to discuss advantages or merits, and also disadvantages or limitations. Hizo ziko kwa notes. Nimewapea. I've given. So that same question, there is another similar question that had been done November 2018. Maybe we can just check whether it's November 2018, question 2, part B. November 2018. The question for November 2018. November 2018, question 2, part B. November 2018. There is a question number 2, part B. You can see November 2018, question 2, part B. So they are given you the Kalman Limited is considering to introduce a new cheap plastic rulers into the market. So this will involve investing in a new plant that was supposed to cost how much? 280 million. So the plant is expected to have a useful life of 5 years, at the end of which its salvage value will be what? Be zero. The firm's policy is to depreciate all its fixed assets on the straight line basis. So that means you take 280, divide by 5 to give us what? The depreciation per annum. Then, due to the market, the unit selling price, unit variable cost, and the annual sales volume for the new plastic rulers have been estimated as follows. So unit selling price, you can see value and probability. Then also unit variable cost, there is also value and probability. Then annual sales volume, that part should be not shillings, it's just millions. The volume so that part of the value, you change it to be volume. You see the annual sales volume. Yeah. So it should be volume, then in millions, not shillings, in millions. Then probability. So that additional information, not one. The firm expects to incur fixed operating cost, excluding depreciation of how much? Yes, they have given it 30 million. So the company's cost of capital is what? 17%, but the corporate tax rate is? So your 17% in the nafikiri mtego iko. Sijui kama iko kwa table. Is it there in the table you confirm? No. So if it is not in the table, so don't close the chapter and go home. You can. I'm only showing you how to get it, just in case it is not in the table. When it is not in the table, you remember 1 minus 1 plus r raised to the power of negative n divided by r. Just in case it is not in the table, so that it will be 1 minus 1 plus 0.17 raised to the power of negative 5, because it was for 5 years. You also divide by 0.1. So that figure that you get, remember to round it off into 4 decimal places so that you can have the same answer. So the question is the same. You can also try that. But this time, this one, there were how many random numbers? Here you can have random numbers. There are 10. Yeah, sawa. Yeah, so this one has more work than the other 2 because it has 10 random numbers. But just try one of them. It will be better for you for your exercise. Nijaribu na mmalize, si ndio? Kenya siku hizi usipomaliza watakufuata baadaye. When you don't finish, they'll be following you later. Yeah. So even when you do CPA, make sure that you have finished. Yeah, don't leave it on the way. Don't leave it on the way. because currently people are having an issue. So we can stop there, try the question, then you finish it.